Good morning and welcome to BVTV. Energy prices continue to dominate market talk, raising multiple questions around the short and long-term implications for the economy, for inflation and by extension for central bank policy. The recent leg down in oil leaves us with some mild underperformance in high-yield energy bonds, which have repriced by around 50 basis points in the last 3 weeks. However, this weakness failed to extend to the rest of the high-yield market, where spreads are relatively flat over this period. Interestingly, the correlation between energy and ex-energy sector returns has plummeted in recent weeks and is now close to its 5-year lows. A couple of arguments may help explain this. First, we're in a very different backdrop compared to late 2015, when lower oil was bad for risk. Today, global growth concerns have largely faded, and there is greater confidence that oil prices reflect a supply issue and not a demand one. Also, this is a reflection of the improvement in energy sector fundamentals, where the surge in defaults has cleansed the high-yield universe. Taking a step back from the oil-high-yield relationship, last week was a busy one for central bank speak. We saw how less dovish commentary triggered one of the biggest rate sell-offs we've seen in many months. UK markets, for instance, are currently pricing in a 20% chance of a rate hike at the next MPC meeting in August, as well as a 50% chance of seeing that rate hike come through by the end of the year. Markets are clearly excited, but in our view, interest rates can only rise if the UK economy makes sufficient progress in 3 key areas: consumption growth, real wage growth, and more generally in Brexit negotiations. On wage growth in particular, there is still not much evidence of a short-term recovery. This chart shows how average weekly wages remain anchored at around 2%. Also, forward-looking indicators, such as private surveys on salaries for permanent staff, have only partially recovered this year, but may lose some momentum as fewer employees are now switching positions since the Brexit vote. With this in mind, we would argue that the chances of a 2017 rate hike remain low. Finally, in currency markets, the euro continues to rally, even if rate differentials with the US dollar point to the other way. This breakdown is now quite evident, but not all that surprising. Europe is now enjoying a fairly smooth ride compared to the UK or the US, where markets might fear political paralysis or a zombie central bank for the rest of the year. With the ECB now seemingly less dovish, even with low inflation, the euro will likely continue to be well supported. So let's talk about the week ahead. On Wednesday, we'll get the minutes from the last FOMC meeting. It'll be interesting to scan for any views around inflation softness in the US. Also on Wednesday, European PMIs are out. Definitely worth following as survey data continues to beat records and expectations. And one final thing before I go, this Thursday, 6th of July, members of the BV team will be heading out to Stevenage to fundraise for Cancer Research UK. This is part of a wider charity effort in partnership with Cascade. We'll be running a number of activities on the day, including bond market updates, financial training, as well as some global food tasting. We look forward to seeing you there if you can make it. That's all from us this week. Please keep following us on Twitter or through our blog at bonvigilantes.com. Have a great week and see you soon.